The reason you lose money in the stock market isn't directly your fault. It is more so the fault of 6 million years of human evolution. Fighting human evolution is not easy, but in today's video, I'm going to give you a handful of strategies that are going to help you win that battle. How many times have you sold a winning stock too soon? How many times have you added to losing positions? In fact, how many bags are you holding right now? Beginner traders are continuously fighting their subconscious to not make these losing mistakes, but they often end up losing the battle because fighting your conscious is an extremely hard thing to do. First human psychological trait that makes beginner traders act like this is called loss aversion. This is the feeling that you get when a loss hurts more than a win feels good. This causes beginner traders to hold and maybe even add into losing positions, just hoping it turns around into a win, and vice versa. It forces them to sell their winners way too early, as just not having it turn into a loss just feels like such a stress relief. And the second psychological reason why traders act like this, that has been proven through hundreds of tests by doctors, is called the sunk cost fallacy. Basically, this states that once you've put money into something, you are more likely to see it through. Or in a stock's case, once you have money invested, you are more likely to continue holding on to that thing, especially if it goes down, because you tie in the sunk cost fallacy with the loss aversion. You don't want to exit that position because the loss is going to hurt so bad. The first strategy we're going to cover in today's video is called the turtle strategy. This is a continuation strategy that looks to buy strength and ride out all that strength until it extinguishes itself. But take note of what is happening with the entrances of this strategy. Once it gets into a position, if that position begins going in the right direction, the strategy will then add to the winning position. How many of you add to your winning positions? If you don't feel bad. Almost no beginner traders do that. This is a skill that I am going to not only teach you about today, because it's easy to teach you, but also show you the statistics behind why you need to be doing this. Also take note of this trade here and take note of how fast this strategy gets out of losing positions. Holds its winners for a very long time, gets out of its losers quickly. So check it out. This is the Tesla chart we were just looking at zoomed in. Currently, it has a drawdown percentage of 7% when running this strategy. Check this out. If I come into my edit studies and global strategy settings, if I only allow up to one order, this is going to get rid of that tactic of adding two winners. Watch what happens to my max drawdown percentage. It goes up. I am now at a 10% max drawdown percentage. How does that make any sense? We're utilizing more capital. Why would the max drawdown percentage go up? Now I want you to take note of something else. We are still on our one order only, so there are no ads happening. 10% max drawdown. We have a gross dollar amount max drawdown of $6,600. Our total P&L is $66,000. Obviously, that attuning to a 10% max drawdown. If we go back to allowing up to 3 orders, so those 2 ads in winning positions come back, I want you to watch this max drawdown number here. It jumps up to 12.1 thousand. It almost doubles. So it's not that we're losing less money. It is that we are making way more money. This is the first major lesson I want to teach you in this video. There will be more coming later. But you've heard of risk reward, right? Every trader's heard of risk reward. When beginner traders think of their risk reward, they think about stop losses and they think about position sizes. They are thinking about, how do I mitigate my risk in this strategy? And that's awesome. That's a great thing to think about. There's absolutely nothing wrong with that. Now, it is only half the equation. You also have to think and have to execute in order to maximize the reward. You can offset risk by making more money. Understanding that, really compartmentalizing that, will help you fight your subconscious and those two tricky psychology facts of the sunk cost fallacy and loss aversion. Because when you begin, potentially, I'm not telling you to do this, this is a strategy I've built, it's a stat that I use, but if you begin to add to your winning positions, and if you begin to really let your winners play all the way out before locking in your profit, the losses aren't going to hurt as much. That loss aversion will start to go away. Hey, I only lost a little bit of money, even though I just made a ton of money on the last trade. Who really gives a damn, right? Loss aversion is so huge for beginner traders because they don't let their winners properly play out. So when they take a loss, it hurts. And that loss hurts even more, once again, because of the sunken cost fallacy. Beginner traders aren't getting out of their losers fast enough. They get in a position that goes against them, they panic, they don't know what to do, they do not want to lock in that loss, they let it come down too hard. The losers end up being bigger than the winners. Now I'm gonna do my best to confuse you here, so stick with me. Remember how I talked about there was two parts of the risk equation. There is risk and there is reward. Well, there is also two parts to the profitable strategy equation, that being win percentage and average risk reward. You can't just make money on a solid risk reward. You need to then multiply that risk reward by the win percentage. I bring that up because I want to show you a second strategy here. This is my custom built reversal trading strategy. You will notice this one also scales into positions. However, this one scales into losing positions. This will enter when the stock is above the 200 simple moving average and below 40 on the relative strength index. And as long as those two conditions remain true, it will enter up to 10 times. And you're saying, well, Trey, didn't you just give a whole spiel about how you should add to winning positions and not add to losing positions? Sure, kind of, but look at what this strategy is doing. Unlike the previous strategy that added to winning positions and then held, oftentimes for months at a time, that strategy will hold. This one is adding to losing positions on dips and then immediately getting out on the first sign of strength. This strategy is targeting a high win percentage, whereas the previous strategy was targeting a high risk reward. I would love to tell you that there are strategies out there that can give you both a win percentage of 70% and a risk reward of 3-to-1. Unfortunately, just basically impossible. Almost non-existent, especially if you look over a large enough time frame. Maybe something can pull that off for 2 months, but how can it pull it off for 15 years? Probably not. So you need to understand your own trade goals and what you would rather target. Would you rather target a high win percentage, or would you rather target a high risk reward? There's not necessarily a correct answer to that. Once again, it depends on your trading goals. What I suggest is that you have a mix of both, that you are constantly trading. Because obviously, the high risk reward strategy has the major con that when it loses more than it wins. Sometimes this strategy gets smacked, if I can find an example. I think COVID, this strategy got owned. Guess what? That's going to happen sometimes with a high win percentage reversal trading strategy. That is the risk of this strategy. Every strategy has a risk. Whereas the previous strategy that traded a lower win percentage, you could go 7, 8, 9, 10 trades in a row without taking a winner. You can go through a real cold streak, that being the major risk of that strategy. So what ends up happening when you combine both continuation and reversal trading strategies into your trading arsenal. They help to balance out each other's risks and build you a more consistent up and to the right P&L curve. And let me show you one more fun trick with this strategy. I want you to once again keep a close eye on this max drawdown percentage, currently at 19%. Our max drawdown gross is just under 2,500, while our total P&L is just over 13,000. Once again, hop back into my global strategy settings. Instead of allowing up to 10 orders, so instead of letting the strategy scale in to its positions, I'm once again only going to do one entry order in the same direction. As I hit apply, once again, keep an eye on my custom backtest study up here. Watch those numbers. Our max drawdown drops all the way down to only $918. Once again, less than half of the gross amount of the previous, but the percentage comes up to 25% because now we are only making $3,600. That once again is the reward side of the risk reward equation showing its head. Do you really want to know how you beat the human conscious of sunk cost fallacy and loss aversion? It's this. It's what you're seeing on the chart. It is codified trading strategies. It is backtest data. These things give you the confidence in the strategy that you know it works. Hey, this strategy works, especially then once you also take this and apply forward testing, which means, hey, I've back tested it. I've proven it works on static existing data. Let me now also go trade very small share size and journal my trades in real time, because there also needs to be a translation between back testing and forward testing. But once you do all of that, once you have these statistics both in the back test and the forward test, you have so much confidence that your strategy is going to work. You will both stop exiting trades too early and stop holding on to your losers. And also, you will stop freaking out after every loss. That loss aversion will go right away because you will see it on paper. Hey, guess what? This strategy loses. Has an 89% win percentage. That means I'm going to lose 11% of my trades. Long as I get out where I'm supposed to, who cares? Hey, I'm in a really big winning position right here, right? I bought in and this stock has bounced up very nicely immediately. Should I get out? Nope. I need to wait and actually wait until the close of this bar or whatever it is so that I'm getting what I'm supposed to be getting out of the reward side of my risk reward equation so that over time I make money. We are all of us are in this game to make money over time. We are not in this game to win trades. Hey, the sunk cost fallacy isn't always a bad thing. If you put your money into investments in yourself, you are more likely to follow through and make the payout on that investment. Over on my website, daytradingstrategies.net, you can sign up under our codes and get access to 90 plus thinkorswim custom coded strategies like the ones you saw today. Studies like the backtest data we've been going over, those labels in the top left, all day today. There's custom scanners, etc., etc. You get access to all of them for one low price. Or if you would like to learn how to build this stuff yourself, I have a 10-chapter, 36-section course also available over on the website, daytradingstrategies.net. Link will be down below. Go check it out, read the reviews, look at the prices, decide if it's something that could help accelerate your trading journey. Hopefully you learned a lot in today's video. We covered a couple strategies which maybe you can take some ideas of and apply to your own trading strategies, but even more importantly, we learned how you can get over both loss aversion and the sunk cost fallacy by utilizing the statistics of an objectively proven statistical strategy. We also talked about how you can even out the curve of your P&L by combining both continuation and reversal trading strategies in your trade arsenal, and much more psychology to help you become a better trader. Hopefully you learned something. If you did, please hit the like button if you would like to continue learning. Make sure you hit the subscribe button down below. With all that being said, I'll catch you all in the next one.